Good morning, everybody, and welcome to our next monthly webinar. And in this month's webinar, we're focusing on not-for-profits. In particular, the title, Disclosing the Impact of Implementing AASB 1058. Now, you'll see in the slides that's available for download or that's been circulated to you earlier today, that we've actually decided to have another look at AASB 1058, put it in perspective before we look at the disclosures. And hopefully that makes some sense as we go through the session. As always, I welcome Kevin Frohbus, a partner based in Sydney, to this webinar. So morning, Kevin.
Morning, Aletta, and good morning, everybody.
All right, so what will we cover in this session? So for our not-for-profit clients or attendees, we look at the effective dates of the new accounting standards, and then we'll go straight to the not-for-profit standard AASB 1058. We'll also look at AASB 15 and what that means for not-for-profit entities. We will recap AASB 16 leases, especially peppercorn leases. And then we'll get to the disclosure requirements. We've also included a section on questions we believe directors should be asking, and we address some next steps or proposed next steps and ask the question, do you need assistance? So if we look at effective dates, our not-for-profit entities have 4 new accounting standards. AASB 9 financial instruments would already be implemented, done and dusted. So the focus of this webinar is really on AASB 15, revenue from contracts with customers. If you have a 30 June year end, it would be applicable 30 June next year, and therefore the date that it's starting is 1 July 2019, and we've already passed that date. If you've got a 31 December year end, we're talking 31 December 2019 financial statements, and again, we're already in that financial year. Similar application dates or implementation dates for AASB 16 as well as AASB 1058. So from our perspective, our for-profit clients have been very busy with these new accounting standards for 31 December 2018, for 30 June 2019. Our for-profit clients only have one new standard that's impacting their next financial year, and that is AASB 16, and they don't have the issue of peppercorn leases. So really our focus is now moving from for-profits to not-for-profits because there's a lot of new accounting standards, a lot of developments, and a lot of lessons that we can learn along the journey. So where are we on the journey? To put it in perspective, in September 2019, whether you've got a December year end or a June year end, these 3 new standards, 15, 16, 10, 58, you're in that first year of implementing those 3 new standards as a not-for-profit entity. Therefore, very important we talk about this. Now, AASB 1058 is the one I would like to start with, and the title is Income of Not-for-Profit Entities. And in previous years, over the past 2 years, we've done various presentations and webinars to not-for-profit entities around AASB 1058. And in most of those presentations, the key question we've addressed were, if you look at income or revenue, would you apply AASB 1058 as a not-for-profit entity, or would you as a not-for-profit entity apply the 5 steps as outlined in AASB 15? And we had decision trees to illustrate that, and all the discussion was around picking between the 2. However, over the last number of months, we've done extensive work in the space. We've assisted a number of not-for-profit entities already to get ready for these new standards. And in that process and in that journey, we've picked up a number of issues, and we thought we should explore this a bit further. We've also, in discussions within our internal BDO team, but also external to BDO and with clients, we found that there's quite a bit of confusion around how AASB 1058 and AASB 15 work together, but also how it interacts with other accounting standards. So where do we start? As a not-for-profit entity, where do I start? When do I look at the appendix to AASB 15, which is specifically added there for not-for-profits in Australia? And when do I look at 1058? And therefore, we've spent quite a bit of time to come up with a big picture, an overview diagram. Now, I know this looks terrible. There's a lot of detail in it, but I think it's quite amazing. I wish I could claim and say that I've developed this decision tree, and it wasn't me. And as you know, I love a decision tree and I love color, but I haven't developed it. Unfortunately, it's also not Kevin. So Kevin, the two of us will have to say that somebody in our team, Alison Wolf, who's a senior manager in our team and very keenly interested in not-for-profits, actually came up with this decision tree. And although it's quite overwhelming, I think once we step through it, you'll see that it's quite amazing. And it gives you a nice framework as a not-for-profit entity to think about these accounting standards. So we'll break them down into three little decision trees. We'll first look at the top one, which is basically in grey. And then we look at decision tree 2, which is dealing with the debit side. And then we look at decision tree 3, the mainly yellow one, where we look at the credit side of the entry. And I'm hoping that it gives you a bit of perspective. Although we're talking about disclosures today, I thought because we've advanced our thinking quite a bit, we would like to share it with our clients. And also it sets the scene very nicely for the disclosures that Kevin will be talking about, because you will see that AASB 1058 in itself doesn't have a lot of disclosures, but AASB 1058 refers you to other standards and disclosure requirements in other standards. I think the best way to explain AASB 1058 is the following. If you are a not-for-profit entity, you will start with AASB 1058. And AASB 1058 is then directing the traffic to different standards. So they would say, maybe consider the standard for a portion of your transaction, and then you come back to 1058 to see where you go next. So AASB 1058 is merely directing the traffic, and it's actually quite rare for AASB 1058 to apply to a transaction in its totality. But what does that mean? Let me try and illustrate that. So if we start with decision tree 1, which is the which is the grey part of that big decision tree, this grey part is really looking at the scope of AASB 1058. Now, as an introduction, we should say that the standard and AASB 1058 makes a general statement in saying that as a not-for-profit entity, obviously, quite often you enter into transactions at fair value or market prices, no problem. But in other instances, and quite often, you enter into transactions that are significantly below fair value. And the reason you manage to enter into those transactions at values significantly below fair value is because the other party would like to enhance and contribute to your objectives. If you're doing cancer research, that other entity is willing to contribute to it, or to provide the asset to you, for example, at less than fair value. So we accept that, we understand that. Therefore, we're saying the starting point for a not-for-profit is 1058. I would say, are you a not-for-profit entity? Yes, you start with 1058. And then your very first question would be, is the transaction to acquire an asset occurring in a not-for-profit entity? So as soon as this is happening in a not-for-profit entity, you would apply 1058. If it's not occurring in a not-for-profit entity, obviously you apply all the other Australian accounting standards, and 1058 would not be applicable. So if you receive a government grant and you're a for-profit entity, you would apply AASB 120. All right. So the transaction to acquire this asset occurs in a not-for-profit entity. Then we say, and it's in the scope of the standard, does this transaction relate to any of the following transactions that are actually specifically outside the scope of AASB 1058? So, for example, if we've got a share-based payment transaction, even though we're a not-for-profit entity, if we've got a share-based payment transaction, 1058 directs you to apply AASB 2, share-based payments. If you've got a business combination, 1058 directs you to apply AASB 3, business combinations. If it's an insurance contract, you go and apply AASB 4, AASB 1023 or 1038. If we've got licenses that are outside the scope of AASB 15, and that would be licenses within the public sector, you develop a policy under AASB 108 because there's no particular standard in that situation. If it's got to do with income taxes, you apply the normal AASB 112 income taxes. And if we've got restructures or administrative arrangements that are within the scope of the old AASB 1004 or what is left of AASB 1004, you apply AASB 1004. So if I'm a not-for-profit entity and I'm obtaining or acquiring an asset, the next step is, does this asset in any which way relate to, share-based payments, business combinations, insurance, etc.? You go and apply that standard. If you say my transaction doesn't relate to any of them, then you stay in 1058, and 1058 then asks you the next question. Does the transaction relate to the receipt of volunteer services? And if you say yes, then you go to AASB 1058, and in particular, you apply paragraphs 18 to 22. If it's a transaction that does not relate to volunteer services, AASB 1058 says, now we've got a process to go to. You have to think, how do we account for the asset received? Or as I've said, what do we do with debit? You go to decision tree 2. And on the other hand, what do we do with the credit? So we look at decision tree 3. So first of all, we have to make sure that we definitely have to apply the rules within AASB 1058. So I'm a not-for-profit, I'm not scoped out, it's not around volunteer services, so definitely I have to apply AASB 1058. Now, as a little bit of an advance notice, if you've got a not-for-profit entity and you have a share-based payment transaction and you apply AASB 2 to that share-based payment transaction, you will also comply with the disclosure requirements in AASB 2. So if we then go on and say, all right, decision tree 2, we look at the debit side of the entry, which would be I've received an asset. Remember, I'm a not-for-profit entity. I've received an asset. So what do I debit? So accounting for the asset received in this transaction, and it's specifically covered in AASB 1058 paragraph 8. And again, what paragraph 8 does, it directs you to other standards. So it says, first of all, is any part of the asset that you've received in this transaction a financial instrument or a financial asset? So if you've received cash, cash is a financial asset. Therefore, if a part of what you've received is a financial asset, for example, cash, then you have to apply AASB 9, which addresses financial instruments and financial assets. So you apply AASB 9 to that part of the transaction. Because it could be that you've received an asset that consists of different parts, right? And it's important that you pick the appropriate standard for the part that you're dealing with. So if any part of the asset you received is a financial asset, you apply AASB 9, and then you come back to AASB 1058 paragraph 8 to consider, how do I account for the remaining part of the asset? Now, if any part of the asset that you've received is a right of use asset because you've leased the asset and therefore you're recognizing a right of use asset, please go and apply AASB 16 to that part of the transaction. If any part of the asset you've received is property, plant and equipment, please apply AASB 116 property, plant and equipment to that part of the transaction. Is any part of the asset received an intangible asset? Please apply AASB 138 to that part of the transaction. And then the last one, the transaction may relate to any other type of asset, and then you apply the relevant Australian accounting standard to that particular asset. So for the debit side of the entry, AASB 1058 doesn't have its own particular rules. It is merely saying, let's consider what are all the assets that we could have within Australian accounting standards, and let's apply the appropriate standard. And then if we move on and we say, okay, but what do we do with the credit side of the entry? So we've recognized for the asset, whatever that may be. And now we have to think, what do we do with the credit side? And this is addressed mainly in paragraph 9. And the default position, if you cannot find anything in paragraph 9, you end up applying paragraph 10 of AASB 1058. And the process is as follows. First of all, you ask the question, were any of the funds that you've received for the purpose of acquiring or constructing a non-financial asset? Because if that is the case, you have to apply AASB 1058 paragraphs 15 to 17, very specific rules. If you've received funds and the asset you would have recognized, your asset would have been under AASB 9 cash, you would have said, I've received this cash, but the purpose of the cash is I have to acquire or construct a non-financial asset, and that is specifically dealt with in paragraphs 15 to 17. So how do we do that? And then, and there are rules there. If it was not funds specifically for the purpose of acquiring or constructing a non-financial asset, the next question is, does any of this related amount relate to a contribution from owners? If that is the case, if it's a contribution from an owner, you apply AASB 1004 and you credit that contribution from owner as part of equity. Again, if there's still something left, does any of the related amount relate to a lease liability? Apply AASB 16. Is there a financial liability? Apply AASB 9. Does any of the amount relate to a provision? Apply AASB 137. And then, after you've exhausted all of that, we get to the crux of the issue, and that is, does the transaction occur in a contract with a customer that created enforceable rights and obligations? But remember, once you get to this question, you've exhausted all other options. You've already considered whether the cash was received to construct a non-financial asset, whether it's a contribution, whether it's a lease liability, whether it's a financial liability, whether it's a provision. And now you're saying, okay, it's none of those. Does the transaction occur in a contract with a customer that creates enforceable rights and obligations? For example, you have to repay the money, or there's a significant penalty, or there's a big cancellation fee. If you say no, we don't have enforceable rights and obligations, then you apply paragraph 10 of AASB 1058, which says you would recognize that amount immediately as income. If you say yes, you're not there yet. If it says yes, you have to say, okay, does the contract include sufficiently specific performance obligations? So promises by the not-for-profit to transfer goods and services to customers. And if you have sufficiently specific performance obligations, so therefore you've got an enforceable right and obligation, and you've got sufficiently specific performance obligations, now you would apply AASB 15 to that part of the transaction. But what you'll see, again, it could be that AASB 15 is still not applied to the whole transaction, and therefore you'll revert back to AASB 1058, paragraph 10, and the rest, the remaining amount, will be recognized as income. Also, if you said we don't have sufficiently specific performance obligations, you would apply AASB 1058, paragraph 10, and recognize it as income immediately. What you would have seen, or I hope you've seen, and I hope I've done justice to the explanation because it's a complex thing, is that in this whole process, you could end up as a not-for-profit entity with a lot of different debits, because you can, as a not-for-profit entity, receive a lot of different assets. And you could receive those assets at fair value, or you could receive those assets at amounts below fair value. And how to deal with that debit ends up as stipulated by the relevant standards, being the property, plant and equipment standard, the leasing standard, the financial instrument standard. But also at the same time, the credit side of the entry, there's a lot of possibilities. And there is an order on how to think about it. And you have to consider whether it's to construct a non-financial asset or whether it's a contribution, etc. And you could, for a particular transaction, end up with a number of credit entries that make up the whole transaction. And it's actually quite rare to end up just applying AASB 1058 paragraph 10 and immediately recognizing the income. So it is a process. I'm going to go back to the big picture. So first of all, as a not-for-profit entity, we start in 1058. We consider whether we scoped out because there's a particular transaction that is dealt with better in another standard. We consider whether there's volunteer services. If we genuinely in 1058, we say, all right, let's look at the debit side of the entry. Where does 1058 direct us to go and come back? And then now for the credit side of the entry, where does 1058 direct us? And then we come back for the remainder. And what does the remainder look like? So that is an overview of the process. You would have seen really a critical thing in the end to determine whether you apply AASB 15 or AASB 1058 around revenue or income comes down to whether we've got sufficiently specific performance obligations. And in fact, if you look at this decision tree, the very last yellow block there is, does the contract include sufficiently specific performance obligations? So that you would consider after you've ensured you've got enforceable rights and obligations and you're not going to apply any of the other standards. Now, sufficiently specific performance obligations are actually creating havoc. And it's a very difficult question. How do we know whether we've got sufficiently specific performance obligations? Because if we don't have this, we can't apply AASB 15. And obviously, a lot of not-for-profit entities are very keen to apply AASB 15 because it gives them a chance or an opportunity to potentially qualify for some form of overtime revenue recognition, which Kevin will look at very shortly. So if we look at sufficiently specific performance obligations, the way we've thought about it, and we've looked at a number, more than 100 government grants and agreements in the not-for-profit space over the last couple of months. And we've came up with 3 buckets. And we said some of these government grants or funding agreements talk about activities, and they only list certain activities that an entity has to do. We give you the funding and we want you to perform these activities, and these are internal activities, really. And then other agreements, government grants, funding agreements, talk about outputs and says we give you funding and these are the outputs that we're interested in, and these are the outputs that you have to provide. So outputs in our mind is saying these are the goods or the services, the outputs that the entity have to provide to the customer. And then in another instance, some of these agreements just talk about outcomes. So outcomes tend to be, we want to achieve the following strategic outcomes. It's like a mission statement, vision, etc. So how does these 3 buckets help us to determine whether we've got sufficiently specific performance obligations? Now, I'll give you an example. If we've got an entity that receive funding and the funding is to increase, let's say, the knowledge of the knowledge of, let's say, electricians in a particular regional area. So we give you the funding and we want you to increase the knowledge of electricians in this regional area. That's the outcome we want to achieve. Now that outcome, increase the knowledge, is quite vague. It's more a strategic outcome, and we would say that is not sufficiently specific performance obligations. That's similar to this is our mission, our vision, etc. However, it could be that the funding agreement says we want you to increase the knowledge of electricians in this particular area, and the outputs that we expect, and I wouldn't call it outputs, but the way we expect you to achieve our strategic goal is we would like you to run 5 training sessions over a period of 6 months. And we would like, they could say how many people they would like to attend, but I don't think that's the important. But the fact is, you're going to run these training sessions, 5 training sessions, 3 hours each. And that is actually the service you're going to provide to me, the customer, in order to achieve our desired outcome, improving the knowledge. So I can see clear outputs. There's going to be 5 sessions run on particular dates, and that's a service we're going to provide in return for the funding we receive. So as soon as we can identify very clear outputs, and outputs could be transfer of goods or it could be transfer of services, I think we can see sufficiently specific performance obligations. Now, it could also be, in order for us to run those events, there's a number of activities we have to do. So we have to design a program, we have to book the venue, we have to do research on what the knowledge gap is. There's a lot of internal activities. Now, those activities we do not transfer a service to the customer. It's internal activities that we have to do in order to deliver the outputs, the performance obligations, the services to the customer, in order to achieve our outcomes, which is to improve the knowledge of electricians in the regional area. So if I think around this, I think what's prescribed in this agreement, is it merely an internal activity? That's not a performance obligation. They're just funding me to do internal stuff. Or Do we get funding in order to achieve certain outputs, transfers of goods and services? Yes, that is sufficiently specific performance obligations. Or is it just funding that is saying, here's funding to achieve certain fairly high level outcomes? Now, often these agreements can have a bit of all of this in, or it could just have activities and outcomes. Sometimes there's activities and outputs, all kinds of weird combinations. But for us, the emphasis is on trying to identify these agreed outputs. And now for agreed outputs, we don't go as far as saying, run 5 sessions for the 3 hours, and you need 50 people in each session. That is, if it is that far and that specific, fair enough. But I don't think it always has to be that specific. If we just want you to run 5 sessions for 3 hours, you can't force people to come. If you've done that, you've achieved the outputs. We think that's acceptable. But that's where the judgment comes in. A lot of judgment around this. Do we just have internal activities, or is it outputs, so transfer of goods and services, or is it just an outcome that is stated? If we go through our decision tree and we have sufficiently specific performance obligations and we have enforceable agreements, it could be that we have to apply AASB 15 to that particular part of the transaction. And if we do AASB 15, have 5 steps. Kevin, I'll throw over to you on the 5 steps so I can have a rest.
All right, thank you, Aletta. And good morning, everybody, if you've just joined us. Having a look at the 5 steps and the core principle, look, once you're dabbling into this area, you really are looking at the contract with the customer almost on a commercial basis. The 5 steps really say, and this is a model applied by everybody across all industries, is first of all, identify the contracts with the customer. And those steps are designed to essentially establish the enforceability of the contract. Now, very importantly, just to remind you that enforceability doesn't mean deferral. In the good old days, which was basically before these new standards, if you had an enforceable contract, the argument went that you might have to pay the money back. And because you might have to pay the money back, the income that was received from these contracts was deferred until such time as you don't have to pay the money back. Very clearly, by the time you arrive in this or these 5 steps under the revenue standard, you would have already accounted for that type of obligation in one of the steps in Aletta, in the complicated diagram that Aletta has introduced. And that diagram is very it's very detailed and it looks complicated, but it's very good model to actually suss out the various clauses and the various rights and obligations. So if you have a repayment obligation, it would have probably been recognized as a financial liability already using the model that Aletta was speaking about. So by the time you get to the core principles in this model, enforceability and the possibility that you might have to pay something back really establishes enforceability, but it doesn't mean deferral. By the time you get into this model, you really get into, you've got the money, yes, you've got rights and obligations to actually do something with it, and you actually have to perform, not possibly pay it back. You actually have to perform, and that's why you're in the revenue standard. In step 2, then you get to identifying the separate performance obligations. Now, in the not-for-profit space, this has been interpreted as being sufficiently specific performance obligations. What that means is, as Aletta has been going on about, is you actually have to be able to measure your progress towards satisfying those objectives in order to apply this model. And the performance obligations are really the goods or services that you are transferring. Once you've gone through that, you have your transaction price. This is the amount you've become entitled to or expected to be entitled to. That is allocated to the transaction price, allocated to the various performance obligations in the second step. And then you recognize revenue when you perform the obligation as satisfied. Now, we've had long conversations about this internally and with a number of clients. There's tendency in the industry to want to essentially spread the revenue equally over on a straight line basis over the period of the contract, essentially an over time recognition. But that's not always the case. The intention of this 5-step model is really, and especially in step 2, to understand the sufficiently specific performance obligation, is to actually understand when exactly do you satisfy and perform under the contract, and can you then recognize revenue to actually reflect that transfer of a good or service. So recognizing on a straight line basis over a contract period really, by experience, only seems to happen when you have a stand ready obligation. So you actually, let's say, delivering a hospital service and you're actually waiting for patients to arrive at the emergency room over a 3-year period. Well, that might be a straight line recognition because you're standing ready. But generally speaking, once you get past sufficiently specific performance obligations in step 2, you will have generally a very good idea of when it is you perform, whether that be at a point in time or over a specific period of time, which won't necessarily be on a straight line basis, but might even just be a couple of months or a week or a particular point in a week where you're actually performing. So don't default to straight lining with this. When you're applying this model, the overtime or at a point in time is really driven by the sufficiently specific performance obligation, because that determination in step 2 drives the recognition in step 5. All right.
Thank you, Kevin.
To the next
Thank
slide.
you very
much. Sorry. Yeah.
Kevin, happy. Anything you wanted to still add on AASB 15? I feel as if I've interrupted you today.
The only reason why you interrupted me, I wasn't actually sure what the next slide was. But it's short.
Yeah, we well rehearsed today, Kevin, and we've just shown everybody that. AASB 16 leases. Now, I know the purpose of our webinar today is around disclosures, but as you've seen earlier, and AASB 1058 disclosures, as you've seen earlier, AASB 1058 could point you to apply AASB 15, but it could also point you to apply AASB 16. In working with our not-for-profit clients, we've also found that AASB 16 is really creating a lot of headaches. And therefore, we thought we should just do a bit of a recap here in this session and link it all together. So you could have a situation where a not-for-profit entity is a lessee. They apply AASB 1058. They have a right of use asset that they have to recognize in terms of AASB 16, a lease liability in terms of AASB 16. And then also we'll address peppercorn leases. Now, the big change that everybody's aware of, that we've got the end of the road for operating leases. So if you're a lessee, you enter into a lease, it will come on your balance sheet. We no longer have operating leases and finance leases. I think the other very interesting thing, a lot of our not-for-profit entities weren't 100% sure about the need to look for embedded leases. So it could be that you have a lot of service agreements where you've signed up to receive a service. However, embedded in that service agreement is actually a lease. And there would be a lease embedded in a service agreement if somehow through that service agreement you've got a right to use an identified asset, and for a period, and you're paying for that, and you are directing the use of that asset during the period of the service contract. So I would just warn you to continue to look out for embedded leases within your service agreements. A lot of our not-for-profit clients would have said we don't have many leases, and then when we start to ask about service agreements embedded in there could be quite a bit of leases. We know that in the AFR there's been a lot of noise about these leases. There's an expectation and that around 100 billion of lease liabilities is headed for balance sheets, and a lot of that could be within not-for-profit entities. And we have on previous webinars discussed the impact that the new leasing standards could have on your financials, your key ratios, and other KPIs. Now, for our not-for-profit clients, often a big impact or a big concern is the impact on forecasting and budgeting, especially within the public sector, to make sure they get an appropriate allocation out of the budget. Again, it has impact on profit volatility, a negative impact on net current assets because your right of use asset is a non-current asset, but your lease liability is split between a current liability, non-current liability. It actually increases EBITDA. It has an impact on bank covenants potentially, depending what your bank covenants are. And then also your interest rate cover, because you've got a lot more interest expenses, and also an impact on your debt equity ratio. A lot of new debt with not a huge change in your equity. So how does that work? I think the other thing that's been interesting, a lot of people have been asking me, Aletta, we have a lease-free period in the first 12 months. So there's no cash flow in the first 12 months of a 10-year lease. How is it possible that we can have an interest expense in those 12 months? And that's one of the weird and wonderful things, even though there is now no cash flow, because you've got a right of use asset on day one and a lease liability on day one, and you're not repaying any part of that lease liability for the first 12 months, your journal will actually be debit interest expense credit lease liability. So in the first 12 months, whilst you're not making any cash payments under your lease, there's actually an increase in your lease liability. So that's another weird and wonderful one that it's maybe a bit unexpected and counterintuitive. We've also, around implementation issues that we've seen to date for not-for-profits around AASB 16, we've listed a few of these. Again, Kevin, would you like to speak to these implementation issues?
Yeah, so the implementation issues, look, I think with these ones, the one I actually want to hone in on is the incremental cost of borrowing. I mean, there's a number of areas up there. So incremental cost of borrowings and also the subleases. Those are the two that I'll focus on with time in mind. The incremental cost of borrowing is the rate that you use when there isn't an interest rate that's implicit in the agreement, which happens essentially almost always with property leases at least, but essentially with property leases, you're not going to have an implicit interest rate. With the incremental cost of borrowing, there seems to be an impression created out there that this is the rate you'll get from your bank. Now, that is a fairly high level assessment of what this rate is. It's the incremental cost of borrowing is actually the rate that would be available for the entity and its credit rating for that particular type of lease, taking into account factors such as the underlying property and also the lease agreement itself. Now, what a number of organizations in the for-profit entity would world would do is they would run to their bank and they would say, well, look, we can borrow funds from the bank at a certain rate, let's say 3%, and they would use that rate. But that's actually just the start of the calculation. If an organization runs to the bank and gets an interest rate from their bank, and let's say it's a 3% facility rate, that doesn't yet factor into account things like the lease period, and it doesn't factor into account things like the underlying property and even just the lessor return in terms of property yields and so forth. In the not-for-profit space, it's much more complicated because a lot of not-for-profits don't have access to the bank. They don't need banking facilities. They don't have banking facilities, and they won't have a banking relationship where they can start with their rate from the bank. So in that scenario, a number of guidances have been developed, including with BDO in our publications that are online. You will find some assistance in those guides on how you build up your incremental borrowing rate for particular leases. And it normally starts with a risk-free rate, linking through to the BBSY spreads, and then also adding on to that a risk factor that's specific to the organization, and then adding on to that various yields and impacts for the type of asset. let's say, property, as well as the period of the lease. It's such a controversial or complex issue that the interpretation committee from the International Interpretation Committee has only very recently issued what I think is the third round of guidance on how to determine these rates. So that is quite complex, and you really should look at that or get some assistance. And then the last one is the subleases. Subleases, where you're a lessee and a lessor, you're actually leasing the asset on to somebody else. So you're an intermediate lessee. That's proved problematic for some of our housing providers in the not-for-profit space. First question you're going to have there is whether or not you are actually a lessor in a finance or operating lease, where you've leased the property, let's say, or received the property from a provider or from government, and then leased it on to, let's say, for accommodation supply in social and affordable housing. You're essentially the intermediate lessor. And the question there is, are you, first of all, leasing it to the tenant as a finance or operating lease? But it also then introduces some complexity into whether or not you, as lessee, have an investment property, because you're earning rental from your lease. So you're leasing it from under a head lease, and then you're on leasing it under a sublease. You essentially are earning rental from that, and that then creates complexities around whether you have investment property and whether that should actually then be treated as investment property at fair value under the investment property standard, AASB 140. And I think in the interest of time, I'll call it at that point. But those are two enormous implementation issues that we've run into recently that you may want to think about.
Fantastic. Thank you, Kevin. I suppose the other ones that's been listed there around lease accruals, lease prepayments, make good provisions, lease incentives. The question is all about if you had lease accruals, lease prepayments, make good provisions, lease incentive balances, at the date that you implement AASB 16, what happens to these balances? Because as soon as you implement AASB 16, you now should have a right of use asset and a lease liability with the consequences of that, depreciation and interest. So there's a lot of discussion around how do we get rid of all those lease accruals, prepayments, make good provisions, lease incentives at the date of transition, and is there scope to keep some of that in certain situations? If you look at lease incentives, a rent-free period will factor into your lease liability, as I've previously explained. Your reduced rent or rent rebate, again, will factor into the calculation of the lease liability. But if you've received a fit-out contribution or a contribution to relocate, previously you would have accounted it under the interpretation, AASB interpretation 115, and what do you now do under AASB 16? My preference would be to get rid of everything and say, how do I incorporate it into my right of use asset lease liability, and we just deal with that. To me, in most instances, if these other things remain on the balance sheet, I would question it if I was the auditor. In certain situations, there's a valid reason for it to stay, but it looks a little bit untidy, I suppose, if we still have carryovers or carry forwards from the old accounting standards after we've adopted a new accounting standard. So that's other things to consider. We've also said that a big thing within public sector entities and not-for-profit entities is maintaining public support. And therefore, it's important to apply these new standards, to communicate the effect of these new standards to users, so that they understand that the business model has not changed here, but we have a new way of accounting for right of use assets, lease liabilities. It has an impact on profit, so profit volatility. It has an impact on liabilities. And the media often, when they report on this, forget that there's an increase. They remember there's an increase in liabilities, but they forget there's also an increase in right of use assets. In our experience, there's a number of dependent risk gateways that help entities to address the concerns around profit volatility and liability reporting. And what we've seen with a lot of our clients is that they don't necessarily have all the old lease agreements, maybe have not identified all the embedded leases in service agreements, and therefore not captured all the related data. Even for clients who thought they have captured all the data, there was a need to go back to the agreement to look for additional information that is now required under AASB 16. Then to come up with judgments on whether, what the lease term is, and whether we'll extend options, etc. Then also finding a technology solution. So at BDO, we've got software as a service that we provide, but we also have an outsourcing service. If you've got a small number of leases where our team uses BDO Lead in-house, but provides all the journals on a monthly basis. So to find a technology solution, and then also, the IFRS advice around it. One of the big things that we've seen are actually the ongoing issues after you've implemented AASB 16. And I've tried to capture it in this decision tree. And that is after you've implemented AASB 16, let's say on the 1st of January this year, and that was a big exercise to capture all the data, to get it in your technology solution or get it in Excel. Now changes occur. And those changes can be put into two broad buckets. The one is changes that are remeasurements or reassessments of leases. And the other broad bucket is modification of leases, so changes to underlying contracts. Now, changes to underlying contracts, modification of leases, is where the lessee and the lessor agree to change the lease term, agree to change payments that are made, etc. And then there's two different ways that could be accounted for. It could be accounted for as a separate lease. And in the situation where that would happen is if there's an increase in the scope where we're adding a new asset and the price that we pay for that increase in scope is standalone price or market values. And therefore, although legally it's a modification of the original lease, to keep it simple, we'll just add it and add that new asset that's being leased at fair value as a separate lease, nice and simple. However, there are instances where we modify a lease, where there's a decrease in the scope, or where there's an increase in the scope, but we're not paying fair value for that increase in scope. They give it to us at a very good deal because we're already a tenant of a property, for example. So if it's in those situations, it should not be treated as a separate lease. It's a modification of the original lease. And there are two criteria. The one is a decrease in scope, and the other one is all other lease modifications. Now, the interesting thing here is if it's a decrease in a scope, I've put it in red, that's a bit of a process. You have to, de-recognize the assets that you are no longer leasing. So you will de-recognize the right of use asset you're no longer leasing, de-recognize the lease liability you no longer have to pay. Those two amounts will not necessarily be the same amount. It will be very rare for that to be the same. And therefore, the difference between the asset de-recognized and the liability de-recognized will give you a P&L impact. And this is a complex process. And then also all other lease modifications that are not accounted for as a separate lease, you have to account for those modified leases at the new discount rate, so the discount rate at the date of the modification. But usually there's no P&L impact because the calculation would have the same impact on the right of use asset and the lease liability. So you'll increase the right of use asset by 100, increase the lease liability by 100. So at least it doesn't have a P&L impact. If I come back to the left-hand side of this diagram, and that is around remeasurements or reassessments of leases, I can give you 3 examples. The standard talks about where there's a change in your original assessment of the lease term. So originally you said you're not going to extend an option, and now you are, or originally you said you're not going to terminate or use a termination or a purchase option and now you are. If that happens, it has an impact on your lease term, and then you have to use the new discount rate at the date that you make the remeasurement or the reassessment, and there's no P&L impact. You could also have a change in estimate of the residual guarantee. So you had a residual guarantee, or let's say a balloon payment on a vehicle of $1,000, and because you've used the vehicle for a certain amount of kilometers, you know that you're not going to have to pay that residual amount. You'll have to pay a higher or a lower amount. You make that change, you make that reassessment. You still use your original discount rate, again, no P&L impact. And then the last one, which is very common, is, and this could happen every month. Every month, a number of your lease agreements could be, the payments in your lease agreements could be impacted because of a CPI adjustment. Because a CPI adjustment doesn't happen once a year for all your leases in the same month. It depends on when you've entered into this lease. So if you've entered into this lease in August and in 12 months' time we have a CPI adjustment, then in August you have to change the payments. It also happens for market rent reviews. You have to change the payments. And remember, if you update your payment in 12 months' time, you will update that payment and all future payments. And again, it will have an impact on your right of use asset and your lease liability, and all your amortization tables, depreciation, everything will be different. So what you can see on this diagram is there are a lot of different changes that can occur over and above entering into new leases. And the different changes that occur lead to different accounting considerations. Sometimes you use the old discount rate, sometimes you have to use the new discount rate, sometimes there's a P&L impact, sometimes they're not. And we're finding that clients struggle with this aspect, the ongoing month-to-month management of lease agreements. And this is one of the reasons that we've started our outsourced service. So, yes, we've got BDO Lead software as a service for those with a lot of leases, but the outsourcing alternative number 2 is really to take the hassle away and managing your leases on an ongoing basis. We've helped a lot of clients and still helping a lot of clients with their transition adjustments, and considering which of the 3 transitional methods are the best and most appropriate. And our implementation advice is around identifying embedded leases. And a lot of what we do is preparing and assisting clients to be audit ready. So we've had a lot of conversations with auditors of our clients where we've said, listen, this is what we've done, this is the calculations, this is why it's an embedded lease or not, put position papers together so it can withstand the scrutiny of audit. Peppercorn leases, as you know, the new AASB 16 have included a paragraph that says if you're a not-for-profit entity and you enter into a peppercorn lease where, for instance, you just pay $1 a year, you shouldn't measure the right of use asset at the same amount as your lease liability, which is very low. You should measure your right of use asset at fair value. Your lease liability will be the net present value of that $1 over how many years, and the difference, you'll go and look at AASB 1058 on what to do with that. However, in December last year, the AASB have issued an amending standard and said, listen, we know it's difficult on determining the fair value of these right of use assets. So they're going to give us a temporary option to defer the fair valuing of peppercorn leases. So it's really important that this deferral is only a deferral of the fair valuing of right of use assets when you've got peppercorn leases or leases significantly below fair value. It's not deferral of AASB 1058 in general. I would like to move on to the disclosure requirements, and Kevin, I'll hand to you on the disclosure requirements.
Thank you, Aletta. And this session is actually a relatively short section because, as Aletta has already mentioned, it's largely driven by the disclosure requirements in other standards. So AASB 1058 is the, shall we say, the distributor of traffic from one standard to the other. So the disclosures follow the relevant disclosures that you find yourself in, depending on where you end up. Now, what I decided to do for this was actually just to refer you to our previous webinars on these topics, being the topics we've done on the three sort of new standards being AASB 16, 15, and 9. And I've actually just did a screenshot there of what you can find on BDO's website if you want to go and find that. That said, there are actually some disclosures in 1058 we must look at. So moving on to those disclosures, there is an objective that comes with 1058. So if you're an not-for-profit in the standard, the general objective is that they want you to disclose the effects of volunteer services and assets that arise from 1058. Now, we haven't spoken much about volunteer services. Volunteer services is for non-public sector entities, essentially a policy choice, whereas in the public sector it'll be more required. So we're already looking then for not-for-profits across the broad spectrum. It's really about the assets that end up within AASB 1058. That being the debit side of the entry. The credit side obviously can end up in places like the revenue standard, the financial instrument standard, the leasing standard. But the one area that doesn't fall anywhere, which is very exclusively in 1058, is when you end up with income that is not accounted for as a revenue transaction or as a financial instrument. And these would be things like grants, bequests, donations, and those types of contributions. Essentially those things that are gifted or actually passed along with very little ongoing obligation or liability or so forth. This requirement follows the requirement in the revenue standard, which is to present a disaggregation of income. So similar to the disaggregation of revenue disclosure in the revenue standard, this requirement is to essentially split your other income or your income amount up in the notes into the disaggregation of what's it made up of. And they give examples of categories in the standard like grants, bequests, donations. Volunteer service would be a separate type of disaggregated category, as well as appropriated amounts for those types of government agencies that are receiving those amounts from Treasury or so forth. Moving along then into the next part of the disclosure requirements. One of the requirements under 1058 is if you have a contribution that is to be applied to acquire or construct a non-financial asset. So this is where you get, let's say, a cash donation, and you are specifically required to use that donation or that contribution to acquire property, plant, and equipment or construct a property that will be recognized and controlled on the not-for-profit balance sheet. In this scenario, the requirement is to actually show reconciliation of the amount that's still sitting there that you've been given as a transfer. Those amounts are generally deferred as a liability until such time as you acquire the underlying asset or construct the underlying property, let's say. The disclosure requirement that follows from that is a reconciliation of how much of your liability did you have at the beginning of the year, how much more did you get in the year, how have you actually then recognized that to income, what judgments have been applied, this is a qualitative disclosure, what judgments have been applied to actually recognize or defer that amount as a liability, and then a closing balance. So what you're reconciling here is the actual liability amount. Essentially what's happening is you're matching the amount received for the construction or acquisition of the non-financial asset with the actual action on the balance sheet to acquire that asset. It's not matching in the income statement or profit and loss, it's essentially matching in the balance sheet. There are a number of criteria that goes with that, and essentially what you're doing is you're disclosing when that liability will unwind to income and the judgments you've made in actually setting that sort of a policy and applying that policy. The other one that they actually require is the patterns of transfers of the liability. You may receive a number of contributions to acquire assets or construct property. And what I mean by pattern of income recognition, you're essentially doing a maturity analysis. And the maturity analysis, not the same as the maturity analysis in the financial instrument standard. This is a maturity analysis of when will my liability actually go to income. Maybe an example they give is using time band. So it might be that you might acquire the land in the next financial year, but the construction will only happen in the next 2 to 3 years thereafter that. And you'd actually then disclose that information to the users and saying, well, this liability, which is actually a contribution received to acquire and construct land and buildings, will be unwound to income over a period of 3 years. In the first year will be an amount that represents the portion that we had to use to acquire the land, and the next year will be the portion related to the construction of the property. And I have seen a number, once again, of property holding companies and community providers in New South Wales where they have large liability balances sitting there, where there are a number of projects that relate to specifically requiring land and building, which will unwind over a long period of time, up to 5 years in some cases. And so this disclosure will be relevant for them. And then moving along into the encouraged disclosure. Now, one of the biggest shocks that come to most not-for-profits is that they receive contributions or donations or grants where the amount actually goes straight to income because there's no other standard that governs it and there's no other obligation to defer it, but it's still subject to restrictions. So this is a sort of scenario where you get a grant and the grant will say, well, you must use this grant for a particular purpose, otherwise you have to pay it back. But obviously that's not recognized as a liability because provided the entity uses it for that person, it will never be paid back. But also there might not be a sufficiently specific performance obligation or any other type of financial liability, and therefore the grant goes fully to income in the year of receipt. Some organizations are struggling with that concept. They struggle with the fact that they've got a grant that essentially is governed by a grant agreement. It's enforceable, but it goes straight to income even though it's got restrictions on use. What the standard says here, it encourages not-for-profits to disclose those amounts that go to income, which are actually subject to restrictions. And the encouraged disclosure is to split your income amount or your equity or your comprehensive income amount into those amounts that were or are subject to restrictions and those that are restrictions free. The last two slides that I have is actually just a snap copy from the standard itself. This is straight from the AASB 105.8 standard. I think it's implementation example 7. And it actually just gives you an example of what an entity or a charity might, or how they might present donation income that is restricted or unrestricted. So you can see in the first two lines, they've split their income into an unrestricted income and a restricted donation income. And then that's kind of flowed through to the total comprehensive income and then also into the actual net assets where essentially the equity has been saying, well, how much of my net assets is restricted and how much of it is sort of unrestricted. So that's an encouraged disclosure. That is not a required disclosure. It's an encouraged disclosure. And I would say that you should probably use this disclosure cautiously, because if you're going to use this disclosure and you're going to present it, your income or comprehensive income on a restricted and a non-restricted basis, then you need to apply that consistently in your presentation, which means all your arrangements need to be assessed so that you can get the disclosure right. It doesn't work where you only show the income from one arrangement between unrestricted and restricted, and then everything else is unrestricted because you haven't done the assessment. You need to apply that encouraged disclosure consistently throughout to all your arrangements. Finally, then, in the last slide, before I hand back to Aletta, is just another part of that disclosure. This is a qualitative disclosure which describes the terms of the grant in the previous slide, on what it was, what the charter of the organization is, and then essentially what the restriction is that goes with that income. So that really then covers the key disclosures under 1058. There's a little bit more in there, and there are some others that are related to appropriations and sort of public sector entities, which I haven't gone into much detail on, but those are the key disclosures that I think you should be aware of in 1058.
Thank you very much, Kevin. So in today's presentation, we thought it's a good opportunity to give a bit of an overview of things we've seen to date when helping our not-for-profit clients, maybe how we've enhanced our understanding of the overall fit together of all these standards, because it's a difficult thing to put it all together. If you need any further assistance, obviously you can contact us for training or advice or policy development. My colleagues in Perth, Wayne and Susan, in Brisbane, Clark, in Sydney, Kevin, and I'm based in Melbourne. Our broader team, you'll see we have people everywhere. Lynn is based in Adelaide. So please feel free to contact us with any questions or requests for help. Thank you very much, Kevin, for presenting the session with me today. Thank you to all of you for attending the webinar. We hope you found it informative and useful, and we hope to speak to you very soon. Thank you very much.